Today we are talking about one of my favorite investing ratios, and if you've been around investing, you've likely heard of PE or price to earnings ratios. It's only one tool to use to evaluate a company, but it's a very powerful tool. So let's take a look at what it is, how it can help you, and then a couple examples of why it shouldn't be the only criteria you use to select an investment. As the name implies, a price to earnings ratio is calculated by taking the price of a share of stock and dividing it by the earnings per share that that company generates. So, for example, in the case of Apple, at the time that I'm recording this, they're trading around $266 per share. And in the last 12 months, they had just about $12 worth of earnings. Now, if we divide that out and we take $266 divided by the $12 of earnings, you get a price to earnings ratio of about 22. We should get the same thing if we take the overall company. Apple, I believe the market cap is around 1.2 trillion. They had about 55 billion in actual earnings or profit in the past 12 months. And so if we divide that out, again, we end up with about 22 times earnings for a company like Apple. So how does this help us? Well, as an investor, you're becoming a part owner in this business. And as a business owner, you're certainly going to care about the actual earnings of your company. Now, price to earnings ratios give you a quick way of relating how much you're paying relative to the earnings power of the business. So with that said, a low price to earnings ratio would always be best, right? Well, not exactly. It gets more complicated than that, so let's take a look. While price to earnings is a powerful tool, it should never be the primary reason you choose an investment. There's a lot more that matters besides just the last 12 months of earnings. To illustrate that, I want to give you a few ways that price to earnings ratio could actually steer you wrong. The first is that earnings fluctuate over time. One-time events can affect the last 12 months of earnings quite significantly. For an example of that, let's take a look at Electronic Arts. So if we go to Yahoo Finance, or maybe on your broker's site, you pull up Electronic Arts, you'll see that the price to earnings ratio they calculate, likely it's right around 11 times earnings. And on the face of it, that looks pretty good because Activision Blizzard and Take-Two Interactive trade at a lot higher price to earnings ratios. So you might think, hey, well, this is great. I am getting more return on my money in the form of earnings. Well, we want to dig into that a little bit further because there's actually some things that this doesn't show. On Electronic Arts website, if we scroll all the way down to the bottom, we'll see a link for investors. And there we can get access to annual reports and quarterly reports. One of the things that Electronic Arts has here, which is pretty helpful, is their financial model, which is a spreadsheet with the last several quarters of results. I've actually already downloaded this, so I'm going to pull up the one that I've worked with a little bit. Here we're taking a look at their income statement. So we'll see that we have net revenue across the top for each quarter. And we'll see that, okay, we had net revenue of around 1.3 billion in the most recent quarter. These values are all in millions. And then if we look down to the bottom here, we see that actually one of the significant contributors that carries through down to net income is this line here, which is provision or benefit from income taxes. And we'll see that in the first quarter of fiscal year 20 and the second quarter of fiscal year 20, there's actually a significant tax benefit that was realized. And in the first quarter of this financial year for them, it's almost a $1 billion tax deferred asset. Now, this is not a video on corporate taxes. I am certainly not qualified to do that, but this is a tax deferred asset. It's not someone handing them a check for $1 billion, but you can see that it has a huge impact on this net income number, and that's what carries through all the way to earnings per share. And that's why in the trailing 12 months, it looks like they have had $9.19 worth of earnings But if we use that number and we divide their current share price of $100.40 by this 919, we end up with that about 11 times earnings. And you can see that really skews the numbers quite a bit, because if we back out this tax impact, we'll actually see that we end up closer to 26 times earnings. You could argue a few different ways of sort of backing out that one-time tax benefit, but hopefully this gives you an idea of just how much of an impact an event like this can have on that price to earnings. If I pull up their quarterly report, or their annual report from the previous year, this was something that was anticipated. Electronic Arts did some restructuring where they essentially sold part of their business to a subsidiary in Switzerland, which handles their international business. And we can see this line here: we do not expect the transaction to impact our taxes or our operating cash flow in fiscal year 2020. A deferred tax asset is probably something that we could make a totally separate, very boring video about. So we'll leave it at this. Don't get so focused on the ratio that is calculated for you that you ignore the effect that one-time events may be having on that ratio. The second way that price to earnings ratio could steer you wrong is if you're ignoring the assets or the liabilities of the business. For that, I want to take a look at a couple airlines. Delta and Southwest Airlines are two of the larger airlines in the industry, and if we take a look at the price to earnings ratio, we'll see that Delta trades at 8 times earnings and Southwest trades just around 13 times earnings. The airline industry seems to trade at a little bit lower multiples or a little bit lower price to earnings ratios than other industries. This price to earnings ratio of 13 for Southwest is actually on the higher side for the industry, but if we're looking at just the price to earnings ratio, one of the things that we would miss is what the cash and debt positions are of the businesses. So if we take a look at the balance sheet for Southwest, and always treat a broker site like this sort of as a summary, we'd want to dive into the quarterly and annual reports if we wanted to really get more precise, but we can use this as a quick reference. This page actually switched over to Delta on me, so I'm going to type in here for Southwest. Let's try that again. All right, so in the most recent quarter, Southwest reported $4 billion in cash and short-term investments. So that's, things like CDs, those kind of things. So basically $4 billion in cash. And if we take a look at the company's total amount of debt, we see it's around $3 billion. So that's a very strong cash position that they could pay off all of their debt and still have $1 billion left over. For a little bit of context to this, I believe Southwest Airlines is around a $25 billion company. Probably could have checked that earlier. $30 billion company, a little bit larger than what I thought. If we go over to Delta, so like I said, they trade at 8 times earnings, which seems quite low, but that's actually not uncommon for this industry. And we take a look at their balance sheet. This switched over to Southwest for me, so nice feature there. Let's switch it back to Delta. Try that again. All right, so Delta, in terms of cash and equivalents, had $1.9 billion. Is what they reported in the last quarter. And if we take a look at their total debt, we see it's at $10 billion. So Delta's been, in theory, more aggressive with using debt to finance the company. That doesn't mean that they're a bad investment, but if you're buying a business, you're certainly going to care what are the assets and what are the liabilities of the business. There's certainly more to assets than just cash, and there are more to liabilities than just debt, but it doesn't get much more tangible than cash when it comes to assets. So when you're trying to assess whether a business is a good investment, you want to at least have some idea of what the debt load or what the net cash position is. Net cash just meaning if they were to pay back their debt, how much cash is left over. That is the net cash position of the business. So both of these could be good investments, but The price to earnings ratio doesn't tell us everything about the whole valuation picture, and for that matter, neither does the cash and debt, but it's a good thing to check as well, and it's sort of a complement to that price to earnings ratio. As we can see, recent earnings are just one piece of the puzzle when trying to evaluate a business. In fact, some companies will be so focused on growth that they're not showing much in the way of earnings at all. They're taking all of their money and putting it back into investments that should grow and increase their business over time. That can be legitimate, but you also want to make sure you're being realistic about the future expectations for that business. Sometimes people get too comfortable with the idea that they've invested into a growth company and they lose sight of the fact that earnings might not be anywhere in the near future. That's a separate topic, but something to consider as well. So while financial ratios are useful, they can be very easily misused. And there's something about sifting through numbers that have been calculated out a couple decimal places that gives us this false confidence or this false sense of accuracy. You need to dive in more than just the ratios that are presented to you and try to understand what is going on with that business as a whole. Price to earnings can be a useful indicator, but it is not a substitute for doing further research. And if you're going to invest in individual companies, it's really important that you be willing to spend time reading through annual reports. The financial ratios may guide you in terms of knowing what questions you need to ask when you get to the annual report, but they're not the answers in and of themselves. If all of this seems daunting and it's not something that you find interesting, there's no shame in investing in index funds. They're a very powerful way to invest. I already have a video on those. Feel free to check that out. I appreciate you watching. If this video was helpful to you, consider clicking the like button. And if you'd like to see more videos like this, consider subscribing and clicking that notification bell as well. Thank you.